Hello, good evening, and welcome to the next session of our taxation series. Again, we have UI Sri Lanka. Specifically, Mohammed Farhan is here in the session for the next session of the tax computations. Uh, you all know Farhan, but Farhan, you can brief out a little intro of yourself for the ones who are joining from these sessions and onwards. Over to you, Farhan.
Hi, Feroz. Thank you very much for the introduction. Just one correction, I think I don't mind that, but I'm from EY Pakistan, not from EY Sri Lanka, but that's fine. So good evening, everybody. This is Mohammed Farhan. Some of you may know me from the second session and the first session on the tax competition. And for those of you who don't know me, my name is Mohammed Farhan. I'm from EY Pakistan. I'm part of the tax practice here in EY Lahore office. I've been part of EY for the past 3 years. I'm actually a lawyer by training, and that actually means that I graduated from law school after 5 years of rigorous training. And then I'm currently also CA trainings as well in prior to joining EY tax practice in our office. So that's a bit of introduction. So we can move on with today's session. So today's session is the third of this tax competition series, and third and second last of this tax competition series, because then after the next session we will move on towards the different topics, but obviously they would all relate to the tax Pakistan tax part. So today's session is going to actually focus on two parts. One part, sorry, I'm actually trying to move my slides. I think there's technical issue. I will try to figure it out and then we can start.
There's a bit of lagging sometimes when you're changing slides on GoToWebinar.
Yes, that can confuse me. All right, so the first two topics for today's session, they are actually from the last session. So as some of you may recall, there were some technical issues. So what I've tried to do is that we'll cover those two sessions, those two particular topics which we covered in the later half of the last session, and then after sort of quickly going over these two topics, what I will try to do is then we will move on to the final tax regime, and then subsequently we will move on towards the collection and the withholding slash deduction of income tax. So I think we can start from income from other sources. So as most of you would recall that there are five heads of income. The first head of income is salary, the second is income from property, then the third income from business, the fourth income from capital gains, and the fifth income from other sources. This is basically a residual head, meaning thereby that anything which does not fall under any of the previous four heads of income would by default would fall under this income head. But obviously, keeping in mind that there can be certain nature of income which would obviously may fall under final tax regime. So obviously, those incomes which are subject to separate charge or final tax regime would not obviously fall under this head of income. However, if any income which is not subject to separate charge or final tax regime and falls under the normal tax regime and does not fall under the previous four heads of income, would fall under this income head. That's why I defined it as the residual head. So some of the examples are that profit on debt is one example of how this would be income from other sources. We would go through profit on debt, how this is a final tax regime income as well. But for companies, some of you may recall that for companies, a profit on debt is not subject to separate charge or final tax regime. Rather, it would fall under the final tax regime. Therefore, since it does not fall under any other heads of income, for companies in particular, this would fall under the income from other sources. Similarly, a dividend is also subject to separate charge of final tax regime. However, if there are some types of dividend income which may not fall under the final tax regime, would by default fall under the income from other sources. Another important example that you may recall from the income from property, when we were doing the example of the income from property, there was one particular example that we did on how if a person leases out a building along with the plant and machinery, how that would not be categorized as income from property, rather it would be categorized as the income from other sources. Similarly, if there's a gift uh, cash gift, right, other than the cross banking channels, right, then obviously that would be categorized as income from other sources. So just a bit of context on this one. Normally, if a relative, so there's a very specific definition of what the relative might be. So if a relative gifts something to another relative, then that may not be considered as a taxable event. However, if in case it's not, let's say, if the gift is cash and it's not paid through the cross banking channel, then in that case, the person who would be receiving that particular cash gift would uh, be subject that income for that person would fall under the income from other sources and would accordingly be accounted for the taxable income under the income from other sources. Uh, as you can also recall from other heads of income, that apart from salary, other heads of income do allow deduction of expenses. But obviously, here the deduction of expenses would be limited in a sense that if a particular expense has been allowed in a different head of income, then that particular expense would not be again allowed for deduction, or would not be again available for deduction under this particular head of income. So that's something to be kept in mind when computing the income from other sources as well. Obviously, capital expenditure would not be allowed, because any capital expenditure is basically an expenditure which yield benefit for more than over a year, and that obviously has its own implication. And we have gone through how that would be treated under the income from business head. All right. So this is a very brief overview of the income from other sources. I think one thing that you can take away from this income from other sources is that it's basically a residual head of income. Anything that does not fall under any other head of income would most likely fall under this head of income. Now, so before I move on to losses, I would like to quickly go over the five heads of income and how the taxable income would be computed. So I know some of you might have asked question how the particular head of income, how the tax for particular head of income would be computed. So what actually happens is that for for each head of income, income falling under that head of income would be computed separately in accordance with the prescribed rules. For instance, for salary, if you are earning salary, this has to be calculated or computed in accordance with the salary head, right? And you may not be allowed any expenses. Then, if we move on to income from property, that income would be computed separately, right? Same again with income from business, income from capital gains, and income from other sources. But at the end, you would uh, accumulate all these different heads of income, and that income would become your uh, sort of taxable income. Why I'm saying sort of taxable income? Because subsequently, what you will do is that if there are any deductible allowances, or if there are any tax credits available, and within the limits, obviously, you can claim those tax credits or deductible expenses against that taxable income. And then we move on towards computing the tax liability by computing the by applying the applicable rates. Obviously, for individuals and association of persons, there are slab rates available, and for companies, there is a fixed rate. For tax year 22, you would find that the tax rate for companies is 29%, and obviously for banking companies, that would be different. Now, I hope that that would clarify how these different heads of income are supposed to work when computing the tax liability under the normal tax regime. Now, moving on to the losses part. So, apart from the salary head, because there are no deductions allowed. Apart from the salary, you are allowed to sort of account for the losses that may accrue under the four heads of income, right? So if and loss obviously means it's the opposite of the gain. It's where your expenses are greater than your income, or that you may be earning. So that's how the loss is defined, right? So for each particular tax head for income head for the year, you can compute your losses, and then those losses can be set off against the income for against the income in under other heads of income, right? Uh, for that particular year, right? Uh, Income from business is one major head of income under which you should know how to compute the losses, because there will be two kinds of losses for income from business. One would be, we simply call it as business loss. The other, we call it as the depreciation or amortization loss. So I think the depreciation or amortization loss, by its very name, would explain that. So basically, this is an expense. This is a loss that may arise by virtue of not being able to adjust your tax depreciation or tax amortization. Similarly, business loss is basically a loss arising under the head income for business, which is not depreciation or amortization. So that's how these two this distinction needs to be maintained. And why that distinction needs to be maintained, we will quickly go through that as well. And then the third type of loss that can be carried forward is the capital loss. So basically, capital loss is the loss falling under the income from capital gain. And I think I had explained this how the capital loss is supposed to be computed as well. Now, how do we carry forward the business loss, and how do we carry forward the depreciation or amortization? So the one major difference between the two is the business loss can be carried forward up to 6 years. However, the depreciation and amortization loss can be carry forward up till the point that the whole of the depreciation or amortization loss has been completely set off. So coming back to the business loss, so basically, if for a year there's a business loss and you're not being able to set off that business loss completely in that particular year, any residual loss that can be carried forward to the next tax year. And obviously, for that tax year, it has its own limitation. That for that tax year, it can only be set off against the business income in that tax year. So that's also important to bear in mind, that the brought forward business loss would not be available for adjustment against whole of the income of for that tax year. It would only be available for adjustment against the business income of that year. Now, similarly, depreciation and amortization loss can would be, as I mentioned earlier, would be carried forward up till the point that it can be fully set off against the business income. All right, and then another uh, difference that would arise is that if you your taxable income after setting off after adjusting your brought forward business losses as well, if your taxable income is rupees 1 million, or less than 1 million, then you would be able to adjust your depreciation against the 100% of that taxable business income, right? However, if the taxable income or the taxable business income is more than rupees 1 million for that year, then you would only be able to claim 50% of your brought forward depreciation amortization loss in that particular tax year. Now, obviously, if you are claiming your depreciation loss against 50% of the business income, and you're not again able to completely set off your brought forward loss, then that loss will be carried forward further to the next tax year, and then again treatment would be applied thereof as well. The third category that of losses that can be carried forward is the capital losses. So capital losses, just like the business loss and the depreciation loss, it would only be available for adjustment against the capital gain in that particular tax year. So it would not be available for adjustment against the whole taxable income for that year. It would only be available for adjustment against the capital gain in that tax year. Obviously, there's a bit of exception here as well, that if there are disposal of securities, and that by securities, let's say the stocks, the shares, listed on the stock exchange, then any loss that would be arising thereof can only be adjusted against the capital gain in the next year that would arise on the disposal of listed shares. So that's also very important, that that distinction needs to be maintained as well. Uh, Another important feature of carrying forward the capital losses is same as business loss, that it can only be carried forward up to 6 years. And if at the expiry of the 6 years there is still capital loss left, then obviously you would not be able to carry forward further that capital loss, and that capital loss will be considered as expired. Now, I think these two sessions I wanted to cover quickly, so that if there were any questions from the last session, you can quickly ask them. Um, Feroz, are there any questions, or should I move on? Hi, Feroz. I think Feroz. All right.
Yes,
So till the
yes,
time, Feroz.
I'm
Uh,
here. Yes, Parani.
Feroz, are there any questions? Because I'm now moving on to the today's agenda.
No, not yet. But
All
I
right.
think we can move on for now.
All right. All right. Thank you. So now, Up to this point, what we have covered in terms of the tax competition, that was normal tax regime. And I think one fundamental feature that we would just quickly go through is how that under normal tax regime is different from final tax regime. That under the normal tax regime, you are allowed deduction of expenses, whereas under the final tax regime or uh, income that is subject to separate charge, no deduction of expenses are allowed. Right. So that's one feature that distinguishes it from normal tax regime. And then obviously, there would be no losses as well. There would be no tax credits available. Um, However, obviously, if there's a withholding and the tax has been deducted, and uh, that withholding can be considered as a tax credit for this purpose of, like, adjusting your tax liability. uh, However, there, in general sense of the word tax credit, there would not be any tax credit available. Also, final tax regime. So some of the examples of the final tax regime, as you can see on your screen, are dividend, profit on debt, and exports. So dividend is basically, as you would know, it's basically a company making distribution of its profits to its shareholders. That's the general definition of the dividend. Obviously, the Income Tax Ordinance 2001 has a very specific definition of dividend as well. So every time there's a distribution of profits or assets, one need to look at that definition of dividend as well. So the the dividend income is subject to separate charge with final tax, right? It would not be considered under any other head of income. There would be separate tax rates available for for dividend. As you can see on your screen, there are three different rates available for companies making for persons earning dividend income from different nature of corporate businesses. The first one is 7.5%. Obviously, it has its very specific conditions that it should be dividend should be paid by the independent power producers, and such a dividend must be considered as a pass-through item under an implementation agreement or power purchase agreement or energy purchase agreement for that matter. Uh, Obviously, pass-through item basically means it must be reimbursed by the power purchaser. So obviously, this is very industry specific, and power sector specific. Another rate is 15%. C. That's a residual sort of tax rate. Anything which does not fall under A and B is 15%. And then the third rate is 25%. So obviously 25% is applicable in case somebody receives dividend from a company where no tax is payable by virtue of tax exemptions available under the second schedule of the income tax ordinance. So these are different rates which would be applicable in terms of the dividend income. And obviously, these would be the same rates as I think we will go through in the later half of this today's session, that how company at the time of making payment of dividend to its shareholder is required to withhold and deposit that income tax as well. So that's one example of final tax regime. Another example of final tax regime is profit on debt. Now, interesting thing to note is that it is not applicable on companies, as I mentioned earlier. Another interesting thing to note is that it is only applicable up to the point up to the profit on debt amount of 5 million rupees. So anything exceeding 5 million rupees profit on debt. that would fall under the income from other sources for individuals or AOP. And if it's less than 5 million rupees, profit on that is less than 5 million rupees, then obviously this would be subject to separate charge, or this would be subject to separate income tax rate. As you can, I think there's again a bit of lag. Um Let me quickly. All right. As you can see on your screen, that the rate, in case of profit on debt falling under the final tax regime, the rate for that, tax rate for that is 15% of the gross amount of the profit on debt received by the person. I hope the term profit on debt would be clear. So in simple terms, this can be considered as interest or markup, and this is that's how the law has used this phrase profit on debt, and obviously as defined as well. Another example of final tax regime, I think then again there's uh, I'm not actually that old that I would actually struggle with the technology, but I'm trying my best to not struggle with the technology. I hope everybody can see the screen. All right. So another example of the final tax regime is the export income, right? The exports basically is one area where uh, uh, final tax regime has been, I think, very consistently has been applicable. Uh, so obviously, any exporter making export of goods, uh, and the proceeds are realized through the authorized banks, then that bank at the time of realization of those proceeds is required to uh, deduct tax at the rate of 1%, right? And that 1% deduction of tax will actually be considered as the final tax liability of the export. Similarly, there would be other export receipts. For instance, somebody who is an lending commission agent might be earning income from non-resident persons on account of the lending commission. So again, the banks would be required to withhold and deposit the tax at the rate of 5% at the time of realization of the exchange proceeds. And then again, such a deduction would be considered as final tax liability. Uh, Another example of it is that if there's an export processing zone authority, right, and that authority would be required to sort of collect income tax at the rate of 1% from its entities, from the specific entities which would be registered within a particular export processing zone. Uh, so these three are examples of final tax. If you have any question, I can pause. If you don't have any question, then I think we can move on.
Farhan, there are some questions.
All right, all right. There's-
Wait a second, I accidentally turned on my webcam. Okay, so Alina Wadud wants to know, so a company is not liable to pay tax on dividends, but an individual is. Is that right?
No, no, no. So if the company is on the receiving end of the dividend, then the company would also be liable for tax on dividend income, right? One thing that needs to be kept in mind is that if the company is on the paying end of the dividend, then the company would be required to withhold tax when making the payment of the dividend. Now, on the other hand, if the company is on the receiving end of the income, then the company, obviously the other company that will be making payment of the dividend would be required to withhold the tax. But the company receiving the income uh, would certainly be required to compute its tax liability under the final tax regime. And if any tax has been or has already been withheld or deducted, then obviously they can take the credit of those deductions and would not have to pay any further tax liability if all the tax liability has already been discharged. But there's no exemption in terms of individual versus company when it comes to dividend.
Okay, so moving on to the next question. Can you please give us some examples of 25 tax on dividend in Pakistan if possible?
Can you repeat the question?
Can you please give some examples of 25 tax on dividends in Pakistan if possible? I think if that is not understandable, we will ask Nadeem to
All right.
retype it.
No, all right. I think that's clear. So one example that I can think of is if I go back to this scheme where I have these dividend rates. So there are two rates. One is 7.5% and the other is 25%. Now, normally, uh, I think the situation now has somewhat changed, but I'm for to keep things simple, I'm gonna take that as an example. So what was happening was that the power companies they had this exemption under the second schedule, and they could claim that exemption, right? So since their income was exempt from tax in under the income tax ordinance, that would be one example where the company making the payment to its the producers making payment of dividend to their shareholders, they would be required to withhold income tax at 25%. Similarly, there would be other companies as well, other businesses as well, who may have exemptions under the second schedule. And if they're not paying any tax liability, obviously they would be required to withhold income tax at the rate of 25% when making the payment of dividend. So
Okay,
we can move on.
there are a couple of questions. Do you want to take them now, or do you want to move on with the presentation?
So if there are like small ones, I think I can entertain, and if there are big ones, so I think we can move on and then take in the next question answer period.
Okay, there are some small questions. Again, Alina Vadut, sorry, before Alina, Hidayatullah. What is meant by authorized dealer in case of export for Section 154?
Uh, so authorized dealer basically means banks. It's the financial institution. It's a very legal question, to be honest, because this is something that the state bank has used this term, and I think the when drafters were drafting this income tax ordinance, they simply borrowed this term from the state bank regulation. However, in simple terms, authorized dealer would mean banks or the financial institutions dealing with foreign exchange.
Okay, moving on to the next one. Exporters don't pay their income taxes then.
I mean, they yes, they don't pay in the term in the sense of the word pay, but their tax liability is just discharged at the time when their foreign exchange proceeds are realized and banks deduct the applicable tax thereon.
Okay, so Elena wants to ask another question. That is, what's the rate of withholding tax in case the company is paying dividends?
Then, as you would recall, there's a residual rate that's 15%. So if that's not the case, if income doesn't, a dividend income does not fall under the 7.5% or the 25% slab, then it would fall under 15% tax rate.
Perfect. Two more questions. If we are still imposing advanced tax on that realized amount from export, then what we should we do?
I'm not sure, first, to be honest, actually the question is. I mean, if FPR still impose advanced tax on that realized amount from export, then what should we do? All right. So, from what I can understand is basically if they are still trying to, make you pay the tax, I think obviously the position can be taken that the tax liability, if has already been discharged, there cannot be any double taxation on the same amount. That's a very fundamental principle of taxation, that they cannot at all be double taxation.
Okay, can individual be become authorized dealer for Section 154?
I believe not. I think, as I said, that it's a term that's been borrowed from the state bank regulations, and I doubt that state bank allow individuals to deal with foreign exchange. I think there's a set rules and procedures. Normally, banks are the authorized dealers, so there can be some, foreign, for some companies dealing in foreign exchange, but generally it's the banks, not the individual. I doubt that the individuals would be allowed to become authorized dealers.
Okay, we are done with the questions. There is a very big question, but I think we can leave that for now. And it would be wise if you could check that yourself, because I might misinterpret the question.
That's fine, Firoz. I think I believe you have done a good job so far. So thanks. I will continue to read those questions as well. So if there is any question, we can resolve. Now, I think we can now move on, right, Firoz?
Yes, Farhan, we can move
And
on for now.
thank you, Feroz. So next topic is advanced text. Now, this slide I have tried to make it as simple as possible to for you to understand, right? Uh, because a lot of times the term advanced text people who are familiar with tax laws, or people who actually deal with tax practice, they would use this term in a different context. But I've tried to make things simple for you to understand the concept of this advanced tax in the larger picture, and how the collection or the deduction of taxes work under the scheme of the income tax ordinance. So basically, advanced tax by its very name is clear that it's a tax that's being paid in advance of your tax liability that may arise at the end of the year when you are filing your income tax return. For instance, uh, uh, to give you an example, companies in particular, they are required to compute their advanced tax liability. There's obviously a given mechanism for that, and they compute their tax liability in a way that they try to sort of forecast their revenues and forecast the profits that they anticipate they will earn those profits or those revenues at the end of the year, and then they divide those, then they compute their tax liability in accordance with those profits, and then they divide those tax liability in 4 quarters, and then obviously each quarter they have obligation to compute their advanced tax, and if there is any advanced tax liability, they're required to discharge this advanced tax liability. Obviously, such an advanced tax liability will ultimately be adjusted against the tax liability that will be computed at the end of the year on actual revenue, on actual profit basis. Uh, so that's just one example of advanced tax, right? Um, However, there's a whole lot of lists of how the advanced tax is sort of collected, or how the tax authorities have come up with these creative ideas of collecting, tax revenue in advance. Because obviously, I think tax authorities, or any tax authority all over the world, they probably would not want to wait till the end of the year to have people pay their tax liability. Rather, they have come up with these different creativities through which they try to collect as much as possible during the year, rather than collecting tax at the end of the year at one point. So that's why they have come up with this idea of advanced tax liability, how the advanced tax would be discharged, how different persons should collect or deduct tax when making payment. So I think you can see on your screen that there are two ways of sort of making people pay their advance taxes. One is obviously the collection. Collection means that somebody is required to collect advance tax, and you will see these are generally different regulatory authorities, or somebody who is in power to make this happen. And another mode of sort of making people pay their advance tax is the deduction or withholding of advance tax. So by name, it's clear that deduction means somebody who is making the payment and would be required to would have this legal obligation to deduct or withhold the income tax as may be prescribed at the time of making payment. So these are two different things that you can see how they can vary from each other. Now, accordingly, these different taxes have their own implications. And how would they be accounted for towards the end of at the end of the year when you are computing your tax liability for a year? How you should be able to account for these taxes that have been either collected or deducted from you during the particular tax year. Now, it can be minimum tax, it can be adjustable tax, and it can be final tax. Final tax we just went through. Final tax means if a tax has been deducted, if you can recall from the export receipt and how the banks are required to deduct tax, that would be final tax, which basically means that it's your final tax liability in respect of that particular income. Right? Accordingly, adjustable tax means that this tax would be adjustable against your normal tax liability that you would have, that you would compute at the end of the year. Let's say on a particular, you have income from business, or you have only income from business, and the tax has been deducted thereof, and somehow that tax is adjustable tax. What you would do is that you would be required to compute your tax liability in accordance with the normal tax regime, depending on if you are individual, we would choose slab rates. If you're a company, you would use a standard rate. So you would compute your tax liability, and that if the tax that has been deducted or collected is adjustable tax, then you would simply adjust it against your tax liability, and then after adjusting your taxes and other tax credit, you will come up with the tax payable. If there is any tax payable, then obviously at the time of the filing of return, you would be required to make payment of the tax payable. However, if there is no tax payable, or if there are any refunds, you would be able to claim your tax refund uh, under the prescribed procedure. Now, The third treatment that can apply to tax that, which have been collected or deducted is the minimum tax. Now, minimum tax basically means that this the excuse me the tax that has been deducted or collected would be considered as your minimum tax liability in a way that you would be required to compute your normal tax liability. And if your normal tax liability is higher than what the tax has been deducted, then you would be required to pay off the differential amount of the two, right? However, if your normal tax liability is less than what the tax has been collected or deducted, then there would not be any further tax liability, and what the tax has already been deducted or collected would be considered as your tax liability in that particular for that particular income, right? It obviously, I think in the next session or the one that would follow that, uh, we will go through there's another minimum tax as well, but in to keep things simple, that tax would be called turnover tax, and that tax would be considered as normal tax liability. But we will come to that as well. For today's session, for this particular topic, what you need to understand is how the minimum tax liability, whenever the tax is collected or deducted, how that would work. That you are required to compute your normal tax liability, and then you are required to compare it with the tax that has been deducted or collected. If there's any positive differential, obviously you would be required to pay tax. If there's any negative differential, there would be any further tax liability to be discharged. At the same time, there wouldn't be any refunds available. Um, so now we can move on to different examples and different sections under the income tax ordinance, which deal with the collection of advanced tax. The first example of that, or the first provision of that, is the collection of advanced tax on import. So anybody in Pakistan who is making imports is would be making imports through the customs, right? And the customs under the section 148 of the income tax ordinance, they are required to sort of collect these advanced tax from the importer, and those rates will vary depending on the 12th schedule. So 12th schedule has this list of different items or equipment or machinery, and there are three tables. Uh, for the first table or the first part, the tax rate is 1%. So custom collector would be required to collect advance tax at 1% on those goods. And if any good is mentioned in the part two of the 12th schedule, then the advanced tax collection can be will be carried out at 2% on the value of those goods. Now, again, there's a residual sort of head as well under this particular collection of advanced tax. If a particular item or machinery or equipment does not fall either under part one of the 12th schedule or part two of the 12th schedule, it would be considered to have to fall under the third part of the schedule. And on such equipment, the collector of customs would be required to collect advance tax at the rate of 5.5%. Now, there will be two treatments. It will be considered as minimum tax liability of the importer if the importer is commercial importer, in the sense that the person is simply importing those goods and without any further processing, is selling onward to its customers in Pakistan. Then that tax would be considered the tax that has been deducted by or collected by the collector of customs, which is considered as the minimum tax liability. However, if the goods are for self-consumption, obviously there is a case that it should not be considered as minimum tax, and then that tax that has been withheld at the time of import of goods, the tax that has been collected at the time of import of goods would be considered as adjustable tax, meaning thereby that At the end of the year, if there is any tax liability, that tax can be adjusted against the tax liability of that particular importer. Now, for purpose of computing the advanced tax collection, the value of goods is actually not simply the value the payment that's being made to uh, the seller outside of Pakistan. It's rather the value of the value of the goods, as well as the sales tax that would be payable on those goods, and any custom duty, if there's one applicable, then that custom duty would also be sort of added to compute the uh, to compute the advanced tax liability at the imports. Another example of advanced tax collection is how different distribution companies are required to collect advanced tax from their consumers. Obviously, not every consumer would be required to would be subject to this. There would be limitations as well. Uh, but a commercial or industrial or domestic consumer, these are different categories of the consumers who would be subject to collection of advanced tax on electricity consumption. Again, if a domestic consumer is active tax payer, then that person would not be subject to any collection of advanced tax under Section 235 of the income tax ordinance. So just to clarify one thing, the active taxpayer basically means that the FPI has this active taxpayer list published on its website, and if your name appears in that particular list on that particular day, it's assumed that you are an active taxpayer, meaning thereby that you are regularly complying with your obligations under the income tax ordinance. Again, there's a different treatment depending on different conditions. The tax collected on electricity consumption can be considered as minimum tax. At the same time, if the conditions are different, the same tax can be considered as adjustable tax. However, for companies, it's very clear that a company, if collection, if advance tax is collected on electricity consumption from a company, that tax considered will be considered as adjustable against its tax liability that will be computed at the end of the year. Now, there are different rates that you can see on your screen. For domestic consumers, there are different rates for consumers other than the domestic consumers. The rates are certainly different. For domestic consumer, if the monthly electricity bill is less than of 25,000 rupees, then obviously no advance tax would be collected. However, if the monthly bill is more than 25,000 rupees, then the advance tax will be collected by the distribution companies at the rate of 7.5% of the bill of the amount. Similarly, another important example, I think it's something that we all deal with. We all sort of have to pay these taxes in one way or another. This is telephone and internet users who are sort of subject to collection of advance tax. If you are somebody who is using internet, which I think pretty much everybody is using these days, or if you are using prepaid cards, or you're using uh, phones in making your bills, then you obviously would be subject to collection of such an advanced tax under the income tax ordinance. And obviously, the companies, the mobile phone operators, they are required to collect these advanced taxes from their consumers and then pay off to the tax authorities of public exchequer. Um, so this is it for the advanced tax collection. In that we will cover in detail for today. And other examples you see, I've mentioned the sections as well that you can refer to. Uh, Advanced tax on private motor vehicles. I'm sure a lot of us would have come across these taxes. Then there's advanced tax on sale of immovable property, as well as advanced tax on purchase of immovable property. So, but obviously there are conditions where you can sort of claim exemption. But in case of sale of immovable property, there are very limited circumstances in which you can claim the exemption. However, I think there's no exemption when it comes to advanced tax on collection of advanced tax on purchase of immovable property. Obviously, when I speak of collection of advanced tax, it means basically in the context of the sale of or purchase of immovable property, it would be the registrar who will be sort of registering the sale date. That registrar or any concerned authority would be required to collect these advanced taxes from the seller as well as the purchaser. Similarly, there are advanced taxes on distributors, dealers, and wholesalers as well. So these are some of the examples of advanced tax collection that are required to be carried out and in accordance with the income tax ordinance. So if you have any question, I think we can pause for that. And Feroz, are you there?
Farhan, I think we should have the prayer break for now. We
Or
can take the questions after that.
all right, that's fine. So are we going to take 10 minutes break?
I think let's make it 13 minutes. We'll join back at 7.
All right, all right. 10 past 7, you mean, right?
Yeah.
All right, that's fine. Thank you.
Hi, Fran, are you back?
Yes, sorry, I was occupied with something at the office. So yes, I'm back now.
Okay, shall we proceed with the questions?
Yes, yes, please go ahead.
Okay, so do you want to cover the big one or just the small ones?
I think that let's take a mix of both, and we can try to cover as much as possible. So smaller the questions, more we can cover.
Okay, so let's start with Shakib Ansari's questions. Uh, Shakib wants to know if a Pakistani registered firm receives remittance from a foreign company only to cover its expenses, the net profit of the Pakistani registered company is negative. So, will there be any minimum tax applicable on the Pakistani registered firm? The remittances from the foreign firm is recorded under other income as it is only for the purpose of covering the overhead expenses.
So there's a turnover tax. I'm assuming that since you're asking this question, you might be familiar with the turnover tax and how under Section 113, company, for instance, is required to compute its minimum tax liability uh, on the turnover. The word is turnover, right? Uh, and turnover, the way it's been defined, it's mostly the income from business. So if it's something that's falling under the income from other sources, then I think it may not be considered as part of the turnover, and accordingly, the tax liability may not be applicable there.
Okay, so the next one is Mohammed Wasif Islam wants to know advance tax and withholding tax are the same or different?
They can be same in the sense that they both are advance. The taxes paid in advance, but they are different at the same time as well. The way these two terms have been used in the scheme of the income tax ordinance, they are different in a sense that withholding taxes often associated with reduction at source, and advance tax is often associated with the collection of the tax by different, either from the tax by the tax authorities themselves, or different authorities or different persons. They are required to sort of collect those taxes and then deposit them with the public exchequer. So they can be same, but I think in the technical sense of these two words, they are different.
Okay, so the next one is Hassan Riaz wants to know can you please explain minimum tax, adjustable tax, and final tax?
First, can you repeat the question?
Yes, the question is can you please explain minimum tax, adjustable tax, and final tax?
All right. So final tax means that it will be considered as your final tax liability in respect of that particular stream of income. And adjustable tax means that the tax, whatever that has been collected or deducted, would be adjustable in normal way, would be adjustable against your tax liability that will be computed at the end of the year. Now, minimum tax is again, it is an adjustable tax, but the adjustment mechanism is different than what the adjustable tax, quote unquote, the adjustable tax would be. So, for instance, let's say if you're providing services and your tax has been deducted uh, at 8% in respect of that those receipts that you will be receiving, And that 8% tax will be considered as minimum tax in a way that you would be required to compute your normal tax liability in accordance with the prescribed mechanism. And if your normal tax liability is greater than the tax that has been deducted, then the positive differential of the two would be tax payable, right? However, if your normal tax liability is lesser than the minimum tax or the tax that has been deducted at the source, that would be considered as your sort of uh, um, final tax liability in respect of the taxable income. However, there wouldn't be any further payment, and there wouldn't be any refund available when you are when you are sort of comparing the two, or getting any different negative differential out of it. So this is how these three different taxes are different from each other.
Okay, Farhan, the final question. The concept of tax, this is Asad Rafiq's question. Asad is saying the concept of tax is to impose tax on income. Income is generated when money comes to you in the form of withholding tax. You said tax can be deducted from payments while a person making payments. I did not get it imposing tax on payments. If you can get it, what is he trying to ask? Then you can answer. Otherwise, I can ask him to unmute himself.
I think I do get his question, and I do understand why he's surprised. So basically, one thing is when a person making so it's not that every payment would be subject to the deduction or collection of tax, right? Not every like exchange of money would be subject to such treatment. So there are only obviously number of transactions which obviously have been prescribed in the income tax ordinance 2001. So the idea basically, as I said earlier, that the tax authorities have come up with these creative ways to make sure that the taxes are tax revenue is collected in advance during the year rather than at the end of the year, because obviously there would be a whole lot of different implications when the tax is collected at the end of the year. So this is a very, I think, creativity that they have applied to get the tax revenue uh, uh, going. Obviously, with the time, they have tried using this creativity. They have tried generating revenues by introducing this minimum tax liability, where they are saying that if these are the transactions where the tax has been deducted, then it would be considered as your minimum tax liability. That is that you would not have to pay anything further if your normal tax liability is not more than what the tax has already been deducted. However, if your normal tax liability is more than what the tax has been deducted, then obviously you would be required to pay those taxes. So that's why the law, they have used the law to collect these taxes from whenever there are payments within the prescribed limits. I hope that would answer your question. I mean, I understand that's not entirely or technically a tax question, but I hope this would answer your, surprise.
Okay. Final question. How to deduct or collect tax when there is exchange of goods or assets other than cash or bank payments?
Interesting question. Let me get back to you on this one. I do know the answer to this question, but I just want to confirm one thing, and then I will get back to you on this. I have noted this question, Burhan, and I will get back to you on this.
We can move on for the slide deck now.
All right. Thank you, Feroz. So second last topic for today's session is deduction of tax at source. I could sense from the question that a lot of people had already gotten to that part where the deduction or the withholding. So this is basically where the different persons, obviously those persons who have been defined or uh, who is required to withhold these taxes. So there are different categories of deductions or different categories of persons who are required to withhold tax. The first one is, I think we all, one way or another, would eventually deal with this, and this is the employer. The employer has been required to withhold tax on whenever they are making payment of salary. Obviously, it's not that they are required to they are required to deduct or withhold tax at every salary, but it's the taxable salary that they are required to withhold, and they're required to withhold by applying the average rate of tax. So this basically means that if you are earning, let's say, a specific amount per month, that would be used to compute your tax liability, and then by using that tax liability for the year, that will be divided over the, let's say, period of 12 months. If you have for full 12 months, that will be divided over the 12 months, and using that rate, the employer would be required to withhold or deduct tax from each month's salary. uh, Obviously, this is something that would be adjustable if you have any other head of income and your tax liability, then whatever the tax has been withheld by the employer, that would be available for adjustment against your total tax liability for that year. Obviously, we have gone through in detail how the salary will be computed, how there are various, perquisites which will be counted towards computing your taxable salary, and then using, if for instance, if you have a employer maintained car, and how that car or how that employer maintained car will be uh, will need to be taken into account whenever you are computing your taxable salary and the tax liability thereof. So so employer, this is one basic example of how the person is required to withhold tax whenever making payment. In this particular case, it has to be the taxable salary payment. If for instance, if it's less than the salary income for a year is less than 600,000 rupees, then obviously there would not be any deduction. Dividend is another example of deduction or withholding of tax. We have covered this already, but for those who weren't present at the time, so any company who is making payment of profits to its shareholders in form of dividend will be required to deduct tax or withhold tax and deposit with the public exchequer at the time of making payment of dividend. So there are different rates. 7.5% is a very industry-specific rate that has been prescribed by the legislature, and then there is a rate of 25% where the company that is paying dividend is not required to pay tax under the income tax ordinance. And the third rate is sort of a residual rate where any type of dividend that does not fall under either A or B would automatically be subject to a deduction of tax at 15%. Now, the third topic or the third part of this topic is very important, and it's a section 153. It's generally referred to as the deduction or withholding of tax when making payments to residents, right? So every prescribed person has this obligation to withhold and deposit the income tax at the defined rates, at the prescribed rates, whenever they are making payment, including by way of advance to a resident person for the sale of goods or for the rendering of or providing of services or on the execution of contract. Of course, it would not include the contracts which entail sale of goods or the rendering of providing of services. So as you can see on your screen, that there are exception within these conditions as well. For instance, if you are making payment of sale of goods, which is less than 75,000 in a year, right? Important to note that it should be in 75,000 should be in aggregate in a year. If it's less than 75,000 rupees, then obviously this would not be applicable. Similarly, if there's a case of payment against the services, then if the payment is less than 30,000 rupees in aggregate during a financial year, then there would not be any withholding obligation on the prescribed person. However, if it's more than let's say 30,000 rupees, then there would be a obligation on the prescribed person while making the payment. So these withholding rates, they vary depending on who the person is who is making the payment, and or not who making the payment, the person who is receiving the payment, and uh, the nature of the payments. The nature of payments can be seen from the three categories, whether these are for sale of goods, whether these are of services, or on the execution of contract. So, for everybody's convenience, what I've done is that I think you can see in the handouts there are withholding rates table that is available on the FPR website. So what I've done is that I've tried to make it available for you guys so that you can access that. And there are there's a whole table in which different withholding rates are uh, given that you can refer to every time you obviously have to look at something. But obviously keep bear in mind that these rates vary. These rates may change from year to year, and that table will keep changing, and you can obviously access it on the FPR website as well. Now, who is the prescribed person? I think that's the most relevant part. That who will be required to withhold tax, right? I've tried to reproduce the whole list of the prescribed person within the meaning of this particular section 153, and I've highlighted number of examples that you can focus on. For instance, a company is uh, by default, there's no other. If it's a company, if the person is a company, it's required to withhold tax. Obviously, if the tax is not deductible, then would not be required to. However, if the deductible, if the tax is deductible, then the companies would be required to withhold and deposit that tax. Similarly, there are other examples you can see on your screen. Now, in case of association of persons and in case of an individual, not every individual, not every association of person would be required to withhold and deposit this income tax. Obviously, there is a criteria, and that who would be required to withhold and deposit income tax when it comes to association of person and individual. In case of an individual, if it's somebody whose turnover in the previous preceding tax year has been over rupees 100 million, then obviously that individual would become withholding agent, right? And that individual would be required to uh, uh, evaluate whether at the time of making payment he's required to or he or she is required to make the payment, and if he or she is required to make the payment, then he or she would be required to withhold and deposit the income tax with the public exchequer. Similarly, the same would go with the association of person. Every time association of person is making payment, it would be required to evaluate whether the that particular association or person meets the criteria of the withholding agent, and if it meets the criteria, then if the tax is deductible, then it would be required to deduct and deposit the tax with the public exchequer. So similarly, there are other examples of the prescribed person as well. Other conditions, other instances where different businesses, different entities, or different authorities may be required to withhold this particular tax. I think I can pause for now because I've covered two, three topics, and if you have any question, I can take now, and then I can move on because I've tried to uh, keep it for 1.5 hours. So if you have any question, then I can take now, and then we can move on, and we will quickly wrap it up.
Okay, there are two questions. The first one is from Hidayatullah. Under section 153, how to consider tax if payment is made through cash instead of check? Secondly, I think you can answer the first one, then I'll go to the second one.
How to consider tax if payment is made through cash instead of check. Secondly, is this limit of for 1 year or is the limit for one transaction? So I would answer your second part of the question. It is so second part of your question is that if the limit of 75,000 or 30,000 is for one transaction or for 1 year, it's basically uh, for 1 year to one person. It's not transaction specific. It's for 1 year to one person. For instance, if you are selling me goods and the amount exceeds 75,000 rupees in that particular year, then obviously I would meet this criteria, right? If it's not 75,000 in the whole year, then obviously it would not, the criteria would not be met. Now, coming to the first part of your question, is that how to consider tax if payment is made through cash instead of check. I think it's the same as when making by way of check, paying by way of check. I mean, if you are issuing a check, you would deduct the tax and issue the check at the uh, total amount less the deducted amount. Similarly, if you are making the payment by way of cash, then obviously you would deduct the same amount from the cash and would pay the residual amount to the recipient.
So the next one is, what's the difference between AOP constituted by or under any law and simple OAP, Association of Partnership?
The one difference that I can see is that sometime association of person is not necessarily that has been created in accordance with the applicable law. I mean, the courts can, excuse me, the courts can declare an association of person or partnership based on uh, what the what the status of the business relationship is, and obviously in otherwise if you have an association of persons, that the law has specifically prescribed that this is how it will be created. That will be one simple example uh, of the AOP falling under the association of person by or under any law. I hope that answers your question. If not, let me know in the question section, and then I will try to respond later. Feroz, are you there?
Yes, Farhan. The next question is, does income tax ordinance allow payment by way of cash instead of check?
Uh, Obviously, there are instances where the cash payments are allowed, but obviously there are bars on that. Not like every transaction can be carried out in terms of cash. For instance, if you recall from the income from business or the income from business section, um, there we had discussed that how under one head you are allowed to make payment by way of cash up to rupees 250,000, right? So obviously, if under one head the income, the expense exceeds 250,000, and then there wouldn't be any cash payment allowed. If the cash payment is made, then the tax expense would not be allowed. So that would be the consequence.
Next up is Hassan Riaz. He wants to know what are the minimum allowed limits of cash payments for services, salary, goods other than banking channel. I think you can refer
Uh,
the relevant section for that.
yes, I think I've responded to your question just now. However, you can refer to section 21 of the income tax ordinance. You would find the relevant areas, the relevant parts which allow how or which prescribed a particular limit for cash payments. It's section 21 of the income tax ordinance 2001.
Okay, Burhan wants to know what to do when the customer doesn't have NTN and deduction has been made from him under section 236H, and also when there is no NIC information available.
What what to do? Sorry, Feroz, I'm just going through the question and then I will respond.
Want me to repeat that?
No, I think I've gotten the question. I'm just trying to recall section 236H because somebody has very specifically referred to section 236H, and 236H sales to retailers. So one thing is that if the customer doesn't have NTN, uh, so I think to section 236H deals with the sales to retailers. If I'm right to recall it, so it's section sales to advanced tax collection on sales to retailers. So basically, that means that if you are in the retail business, then a distributor or the manufacturer, whoever is making sales to the retailer, would be required to collect advanced tax. Now, I'm not sure if your question is from a different perspective because this particular NIC information, I'm not sure what particular section that you are referring to when it vis-a-vis this NIC information. Is this something that's related to sales tax? If you can clarify, Burhan, that would be great. Now, while you clarify that part, if when you are making a payment and you do not have NTN, or you do you're not an active taxpayer. So uh, in simple circumstances, you would be required to understand schedule of the income tax ordinance. The deduction or the withholding would be increased by 100%. What that actually means is, let's say you are making sale of goods and you were required to withhold tax at 4%. As a company, you were required to withhold 4 tax, and the recipient of the payment is not an active taxpayer, then the withholding would be increased by 100% to 8%. So now the company would be required to withhold tax at 8% instead of the 4%. So that's the consequence if you do not have NTN, leading to you're not appearing in the active taxpayer list.
Okay, Shabazz is not clear about the AOPs. He's requesting please give some examples of AOPs constituted by or under any law. Farhan, are you there?
Oh, sorry, I think I was on mute. I can respond to this question at the end, and I will revert to the today's session, and then we'll try to respond in whatever possible manner at the end of the session. Is that fine with you?
Yeah, sure, why not?
All right, thank you. Uh, so another important section for withholding of income tax at or deduction of tax at source is section 155. We have skipped 154 because we have already covered that part. That relates to exports, so that we have already covered under the final tax as well as the collection of advance tax. So under section 155, every prescribed person. Again, the prescribed person has been specifically mentioned in the law as well, is required to withhold tax at the prescribed rates whenever making payment of the rent uh, at the given rate, right? If you can see that there are two different rates, one for the companies and the other for the persons other than the company, which obviously would include individuals and association of persons. Right. For companies, if there's a flat rate of 15%, if anybody's making payment of uh, rent to the company, then the person making the payment, given that it's a prescribed person, that person would be required to withhold tax at the rate of 15% of the payment of the rent. However, in case of individual and association of persons, if a person is making payment to an individual and the rent amount does not exceed 300,000 rupees, then obviously the rate of there would not be any withholding. However, if it's more than 300,000, then there are different prescribed slab rates which would be applicable in that particular scenario. Similarly, prizes and winnings. If anybody thinks that they have win a prize and they would not be subject to uh, tax, you're kidding with yourself because every time you are gonna win a prize, the government is gonna come running to you asking for their share of your prize. So they have prescribed their share of the prices, and 15% of the gross amount would be deducted on prize bond or crossword puzzles. and 20% of the gross amount would be deducted on winnings from lottery prize, or winning a quiz, or prize offered for promotion of sale. This is an interesting section as well. Now, obviously, there would be cases in which a particular person may be meeting the condition in terms of tax deduction. However, if that person is not if that person's income is not subject to tax in Pakistan, then there are ways under the law that have been prescribed when the tax when that person uh, may get this relief from deduction of tax. However, for that to happen, under Section 159, such a person is required to make an application to the tax commissioner, and the tax commissioner, depending on the circumstances of the case, may issue an exemption certificate, as we call it, or it may issue a reduced rate certificate, depending on the situations. In, so not that if you meet the criteria of withholding, you would automatically be subject to such a withholding. If your income is not supposed to be subject to tax, then you have a relief to claim. However, there is a prescribed procedure for that. So this is it for today. Um, and then now I think I can move on towards the questions. And I will, Firoz, are you there?
Yes, you were breaking up, but now you're fine. Okay, so there are two questions, but people, if you have any questions, please start typing in so that we can wrap it up in time. Mohammed Bilal wants to know, is it possible that tax withheld on one head of income can be adjusted against any other heads of income?
So obviously, whatever the tax has been withheld, depending on if it's minimum tax or your final tax or adjustable tax. If it's final tax, it will obviously be not adjustable against other heads of income. However, if it's adjustable tax or minimum tax, then your normal tax liability is computed after taking into account income from all heads of income. Once you compute your normal tax liability under all heads of income, and that's accumulated, and then their tax liability is computed, and if your tax has already been deducted, or you have already paid some advance tax, then depending on if it's adjustable tax, so then you can adjust against your normal tax liability, which obviously would cover all heads of income, not a particular head of income.
Okay, so the next one is from Shabazz. Shabazz wants to know who gets exemptions or lower tax rates certificates.
So, lower rate, tax rate certificate would be one example where under the second schedule, a specific rate has been not under the second schedule. If there is a tax liability, your tax liability is not same as it's supposed to be, and if the tax is deducted and your tax liability and the tax so deducted would be higher than the your tax liability, then you can make a case for lower rate tax rate certificate. That would be one example. And for the exemption certificate, one example would be where, let's say, your income is not subject to tax, and there is a specific exemption in respect of that income. And if somebody is deducting a tax, then you can make a case that since your income is not subject to tax, then there shouldn't be any withholding, as you would not be liable to pay any tax at the end of the year because your income is exempt from the income tax liability under the income tax ordinance. So this would be one example of the exemption certificate.
Farhan, there aren't any question. No, we have another question. Sorry. Can you please refer relevant sections or schedule for exemptions or lower tax rate certificates?
I think you can refer to second schedule. There isn't any like specific exemption certificates or the sections covering the exemption certificates. However, second schedule covers a whole range of exemption and reduced rates and different provisions not being applicable in certain cases, and different sort of criterias are prescribed. So second schedule is one schedule that you can refer to for the purpose of exemptions or for the purpose of reduced rates.
Farhan, there aren't any questions for now.
All right. Is somebody speaking? Hello. Rose, can you hear me?
Yes, Farhan?
Can you hear me?
Yes, yes.
All right. All right. So I think if there isn't any question, then I can respond to one question that I had left for the end. So let me open that question. Hmm. So you had asked for an example of how an association of persons constituted by or under law would be different than an association of persons having a simple association of person, as we said. So whenever there is a association of persons, you are required to register your partnership deed under the Partnership Act 1932, right? And obviously there would be registration, and it would be called firm. There would be a registered name. That is one example of an association of persons constituted by under law, right? Now, on the other hand, if an association of persons is something that the two persons are simply coming together and they are sort of working together, they can be deemed as association of persons because the law very clearly says that it's not. They can be declared as association of persons. They will be declared as association of persons. They might not be registered with the registrar of the firms, but they will be considered as partnership within the meaning of that particular section or within the meaning of that particular law. So that would, I believe, that would be one example of the simple AOP, and the example of how it's being constituted under the law. All right. So I think I left another question as well. I'm not sure if I can recall. Uh, can you recall, Feroz, if I had left any other question?
Yes, Farhan, I'm checking that. Just give me a second. Did you answer the Burhan's question?
Yes, Burhan's question. It was Burhan's question. Can you sort of refer me to that question? Oh,
Just
all right. So, how to deduct or collect tax when there is exchange of goods or assets
yes,
other
yes.
than
That was the
cash
one.
or bank payments? All right. So that is one interesting question, and obviously, you would there can be difference of opinion on this question. Now, the law says when you are making payment, right? You are if a person is making a prescribed person is making payment, then at the time of making payment, you are required to withhold and deposit tax. Now, in case of goods or exchange of goods or assets, there is an argument that it's not a payment. It cannot be considered as payment. Therefore, there should not be any withholding applicable thereof. So that's the answer to your question. I hope you can understand. Feroz, are you going to make the announcement, or should I make the announcement of for that solution of the exercise that we had shared, I think, a couple of sessions ago?
Yes, you can take that up.
All right. So I can already see one comment slash question that
About the
when if
changes.
there's going to be a solution. What I would like to announce is that those of you who have not shared your solutions are requested to share their solutions at the earliest. Is that by tomorrow, Feroz? Like, should they share by tomorrow or by Monday?
Yes, I think they should share it by tomorrow. I have
All right.
shared the link with them so that so they can submit their solutions last Monday, the one that we just missed. But I think tomorrow would be fine.
All right.
Okay.
As soon as possible, but no later than a Monday. So you can submit your solutions, and on Monday we will share the solution as well, so that you can compare the two as well. Is that fine, Feroz?
Yeah, I just want to make one more announcement. The handout sections contains the recording links document. All of you need to download that. It has the drive link, and the drive link contains all the presentations by EY for Sri Lanka and Pakistan both, and the assignment is also uploaded in the drive. So if you guys don't have the assignment with you right now, you guys can access the drive and download it. Perfect. And we can, I'll share the submission of assignment link with you guys as well. And see you guys tomorrow in the unmoderated session where we can discuss this assignment with other participants as well. Okay, Farhan. See you on Monday for the next session.
Yes. Yes, hopefully I will be the one making the presentation on Monday as well.
Sure, that's perfect. So goodbye everyone for today. Thank you so much for attending these sessions. I hope you have learned a lot, as these sessions were the most awaited sessions by our six-digit participants, as well as other ACC members who were waiting on to get their CPDs done. So thank you so much for attending these sessions and holding on. Yamna, I will share the link with you guys where you guys can upload the assignment by yourself. So until then, bye bye and see you on the unmoderated session tomorrow. Thank you, Farhan. Goodbye, everyone.
Thank you, Feroz. Goodbye, everyone. Have a nice weekend.